service members have an edge over civilians. If you want to build a real estate portfolio, if that's something that you truly want to do, the program is perfectly outfitted to do so on multiple levels.
So I'm here with Todd Nutsch with United Home Loans, and we're here to talk about utilizing your benefits as a soldier and veteran, the VA home loan. Todd, thanks for sitting down with me and talking for a bit.
I appreciate your time. Yeah.
So real quick, actually, if you wouldn't mind, give me a quick rundown of how you got into being a loan officer. Is that the correct terminology?
Yeah. Loan Originator would be the job title, if that makes sense. And years ago, I was self-employed and had been on multiple sides of loan transactions on the other side of the desk. And I sold my company and had an opportunity to go to work for a local community bank. And at that point in time, I'd been there about 90 days, and the individual in charge of mortgage lending for that bank decided to leave, and so an opening presented itself, and the bank president asked me if I would take over mortgage lending, which I didn't know anything about at that point in time. And so that was right at 2015, right after all of the new regulatory issues after the crash in 08, 09. And really, quite frankly, the guys at the bank didn't want to take on all of that new learning. And so they handed it over to me to take that over. And that's how I got my start in mortgage lending, was with a community bank. And then progressed from there. A few years later, left and went to a retail group, and now I'm currently working for a local independent mortgage broker.
Okay, and real quick, just to clarify, you don't just do VA loans, right? It's all mortgages.
Correct. Every type of loan product that's out there, from VA to FHA, USDA, those are all your government-backed loans, but I also handle conventional loans, and then we have a number of specialty products, from HELOCs to more of the some investment products, the DSCR loans, and even for self-employed individuals, we can do what are called bank statement loans.
So if you could give a real quick rundown, what is the difference, do you think? Maybe there's a benefit, or even just the process-wise. What's the difference? You brought up being a independent. You were working for an independent firm, and now you're currently you're working for a retail broker. Now you're working independent. Are those two different entities?
It has to do with the back end regulatory guidance that comes down. Consumer Finance Protection Bureau, CFPB, you might hear that in the news lately. There's some changes coming up there. But it's the regulatory guidelines. Community banks have a set of rules. Retail lenders have a set of rules. And then we as mortgage brokers have a kind of a different set of federal guidelines that we have to follow. And it all comes down to compliance and a lot of the back end of how we operate. It also deals with how we are licensed as individuals. Some banks have nationwide licensing, and then some retail lenders have nationwide licensing, but then also some of them you've got to go state by state as a mortgage originator, and myself as a mortgage broker, I have to be individually licensed in every single state that I want to operate in and do business in.
So technically, okay, so how many states are you licensed in?
Currently, I've backed down. I seem to have enough business here in our current market that right now I'm just licensed in Kansas and Missouri, mostly to capture. I do enough business out of the Kansas City market. That way I get on both sides of the river and can take care of business over there as well.
Nice. Yeah, and so Can you give us a quick market snapshot? What do you see in the market doing right now?
The real estate market is strong. It is especially that's a question that really needs to be asked on an individual market by market basis as to what's going on. Here in our market, we have definitely flipped heavily to being a very much a seller's market. We are very short on inventory. There are a lot more buyers out here in the market than what we have homes to actually service and fill. And so it's going to be an interesting year between what we have going on, economically. What are interest rates going to do? They've trended down a little bit in the last week to a couple of months. We're entering into an area where interest rates aren't really the issue anymore. We're having way more constraints on having enough available homes for individuals to actually move into.
And what would you have to say to the person who currently has home, maybe is considering selling, but they're a little nervous about the market, and then kind of attached to that the interest rates, and maybe they want to hold on to their 3-4% interest rate that they've had, and they're worried about trading up to a house where it's like a 7%.
That's a great question, and it's one that takes a deeper dive into each individual and what's going on in their current finances. And there's a lot more that can go into that discussion. It comes down to, we have a lot of other things going on in the economy right now. We have credit card debt is at an absolute all-time high. So debts other than the home really factoring into a personal finance discussion. If I have an individual that approaches me that's like, hey, would this be a good move? We sit down and we talk about the rest of their finances and what's going on. And I can even calculate what's called a blended rate to give them an idea, not only that they may be sitting on a 3% mortgage rate, but they may be sitting on credit card debt at 20 to 27% interest rate. And so taking a little more holistic look at the individual's finances to see what's going on. Then we take a look at just what's going on with their family. It's a deep dive, asking questions of, what's coming up for them. Number of individuals in the household. Maybe they're expecting another child. Maybe they're going the other direction. Maybe they've got kids that are, approaching the end of high school years and will be moving out, going on to college. Maybe they don't need quite as large a home and might be looking to downsize a little bit. And so looking at kind of all of those factors, the best thing for individuals to kind of keep in mind is that we look at the interest rate overall, all of their financials, to see kind of where they're at, and would a move forward, especially if we could maybe sell a home and eliminate some debt, what would that do to that blended rate overall? We take a look at all of those factors before, ultimately it's their decision. Some individuals are just really stuck on staying in that lower interest rate home, understandably. So it really kind of depends on what they've got going on with the rest of their household and what the next couple of years holds for them.
Yeah, I think that's really important. And this is the benefit of contacting and working with someone like yourself, even when you're just thinking about selling or buying, because there's so much fear-mongering around interest rates, and it makes it seem like that's the only thing to consider. It's like, where's the interest rate? And that's my, invitation in or my exit out of the market. But I mean, an interest rate, say if someone owns a house and wants to sell after 3 years, that interest rate sometimes doesn't make a huge difference,
Correct.
And that's something that I always try to encourage buyers or sellers that I talk to is that let's look at the full picture. Let's look at what your goals are as well. If it's just about finances in the sense of, oh, hey, we just want a low price on a home. Okay, that's one thing. But sometimes, like myself, I ran into this a couple of years ago. The necessity of life requires you to find a new space. Yeah. But Let's jump into just specifically the VA home loan. And can you give me a brief flyby overview? I mean, there's more than one party, right? There's the loan originator, there's the realtor, and kind of the title company as well. There's kind of different aspects going on, as well as the inspector, whatnot. But from your purview, your point of view, what's that overview of utilizing that VA home loan to purchase a home?
To me, it really comes down to individual experience and what you're used to. There can be a lot of confusion out in the marketplace with the VA home loan, and typically due to lenders or buyers or realtors that may not be familiar with the loan product. And quite frankly, I would prefer to do a VA home loan over any other loan product that we have out there. It's really designed to be flexible and meet the needs of the service member as they're making multiple moves, where a lot of individuals, civilians, might only move a couple of times in their life. Those soldiers are making duty station transfers every 36 to 48 months, and you've got to have a loan product that can keep up with that pace of home buying. And it takes if you have the right team members involved, the right realtors, the right title companies, the VA home loan is extremely smooth and very user friendly for the consumer.
And kind of talking about pace, right? Timing. How far out, right? If someone's PCSing and they know they're coming to Fort Riley, but it's maybe 3 months away, 4 months away, maybe it's only 1 month away. Like how I'm going to say this. What are the general timelines of utilizing that VA home loan, coming from getting pre-approved or pre-qualified to getting keys in the door?
Yeah, that's a lot in that question.
Yeah,
and a lot of variabilities. Let's break it down really from look at the lender perspective. You could go under contract and close a VA loan in probably 15 to 20 days on the short end. And so if it's we've had several instances maybe of the Army changing orders here recently where individuals were midstream, and we had to pick up the pace in order to meet their report date. We can still do that. Now, at that point in time, we do have to kind of have a large conversation with the realtors that are involved. We've got to jump on ordering appraisal right away, because that's another outside factor that can take at least typically 10 days in that process to pull that all together. And so from a speed standpoint, we can move really quickly if we need to. Next comes what's going on in the market. How soon are you looking at moving into an area? We are experiencing right now some really long escrow periods. And part of that has been individuals reaching out, visiting with realtors, having conversations about the shortage of inventory. And so in that instance, the sooner you can start looking, the sooner you can potentially find a home. It may be a little longer escrow period in order to get into the home, but that's really giving you the best optimal chance to find the right property that's the right fit for you. Pre-qualification process on the lender side, that's a 24 to 48 hour discussion. At that point in time, you're under contract. And then it's just a matter of a discussion with between the buyer and seller of, hey, what's the mutual closing date between the two parties?
And real quick, I want to get into pre-qualification, pre-approval, kind of start at the start, so to speak. But if you could, what is an escrow period? define it for those who have never been around, never even sure what escrow means.
Yeah, a lot of times we forget that the terminology that's coming out of our mouth, it's secondhand to us, but people might not understand. Escrow period is really at the point in time that you go under contract and you've engaged that title or escrow company to start the process, and they're collecting an earnest money deposit up front, and then you have a closing date at the end in which you, as the buyer, are signing all of your final loan and closing paperwork and ultimately taking possession of that home. And so that escrow period is the duration between going under contract until you're signing that final paperwork.
All right, that makes sense. And so for someone who's never bought a house, never shopped around for a loan, and they want to get started, they want to maybe talk to a few different loan companies, maybe they want to shop around in that sense. What are some good questions to ask to find if a loan originator is a good fit for them?
Well, working with a loan originator is really, that's a bit of a personal discussion, a personal relationship. What I visit with a lot of my clients about is that my hope is to not only set them up to have a successful transaction this time, but I want to know enough about that individual in order to make sure that we do the best that we can to ensure their success on the next transaction. Not all loan originators are going to take that approach. A lot of the online origination groups really don't even get into a discussion about, how long before you get out, how long before you hang it up and you move back to, wherever home, is going to be for you. And that career path for our soldiers becomes a critical discussion. Understanding how long they anticipate. Nobody can really predict what the Army's going to do, but trying to have an anticipation of how long is that current duty station. So if you're looking for some additional advice that's not just a very transactional occurrence, with that one home loan purchase, your loan originator is going to make a huge difference in helping you plan forward what's going on and ask enough of the right questions. And so, trying to find out what you are looking for in the transaction. If you're looking for more of an advisor, then you're going to ask some questions about, what's the availability of that loan originator? Are they available after hours, on the weekends? Are they only going to be available during the pre-approval, pre-qualification process? Or is this an individual that you will have contact with even after closing to check in and see? Right now with the current rate environment, we're anticipating hopefully that things continue in the right trend, and individuals may be looking at a refinance in the next 12 to 18 months, and that relationship with that original loan advisor, if you will, is critical at that point.
Yeah, that makes sense. So maybe as easy it is, certain companies have those, you see an advertisement online, you get to the website and you're ready to pre-qualification, pre-approval right now, you're just filling out a form. That may be easy and that might be beneficial, timeline period, but in general, that process doesn't seem to take long at all, right? 24 to 48 hours. So it might behoove, right, the buyer to maybe shop around a little bit and maybe make some phone calls and meet who they're going to be working with prior to working with them.
There's a lot of different ways for loan originators to formulate a loan strategy. A lot of times we see the VA standard guideline will allow lenders to charge an origination fee based on a percentage of the loan amount, and not all lenders will go that route. Some lenders will go to just a flat rate fee. It doesn't matter whether you're buying a $400,000 house or whether you're buying a $200,000 house, those costs come into play. An individual who's charging a flat fee, you know exactly what that's going to be, where the percentage individual, the difference between, that $200,000 home and $400,000 home, that could be as much as, $2,000 in additional expense to you. That's cash coming out of your pocket. And if that loan originator is not giving you a good, solid loan estimate up front, you're not really going to know what that loan is truly costing you.
Yeah, that makes sense. And so they're starting off, and this is something that I think people get a little confused, and maybe you could talk about and break the two up and define them. Pre-qualification, pre-approval. A lot of people know that's the first step, but there is a little bit of minute differences maybe. What's the difference there?
It's one of those, it's really semantics, and there's no real hard and fast rule. That's the thing to keep in mind. Different organizations will use the terms synonymously. The thing that you need to understand in that process, really what we're talking about is the initial pre-approval, pre-qualification, whatever you want to call it. It's the due diligence on the front end of the loan originator in delivering you and the realtor a game plan of what you can afford and what you can spend on a home. In some instances, pre-qualification is leaning to more of your online lenders who aren't really doing a lot of verification up front, where a pre-approval, typically your credit is pulled with a pre-approval. Documents are collected and verified before issuing the pre-approval. Some lenders mash all of it together, and they may call it a pre-qualification when they have done some due diligence up front. So it's not a hard and fast rule to the definition, but what we're talking about is how much work has been done up front to make sure that you can qualify for the loan program. And that's the biggest thing to keep in mind in this pre-approval process. And one of the beauties of the VA home loan program is the amount of flexibility from a financial standpoint that can be approved. And so the bigger issue that I have with a lot of my VA clients is not so much the total purchase price of home that they can be approved for by the standard of the guidelines. I start having questions with them about how much house payment are you really comfortable making? Because oftentimes I can pre-approve you for a purchase price that's way outside your comfort zone of, what kind of house payment that you're trying to make every month. And so that pre-approval, understand that you may be approved for a $400,000, $500,000 home, but if you're not comfortable making a $3,000 to $4,000 a month payment, then you need to be having a discussion with your loan originator about that pre-approval and what is actually a house payment that we're comfortable with.
Yeah, so when I was an E4, when we first bought our first house using the VA loan, and we were pre-approved, one income household, my own, and nothing special other than that, one kid, and we were pre-approved for $450,000. And then I'm like, okay, well, that's nice to know. That sounds good, but
yeah.
I wanted at the time a house that I felt like I could work at a fast food joint and pay off the mortgage if the Army, didn't work out or something like that. But it is something to watch out for, because I think, too, we also have this, there's a bit of an aversion to the starter home, right? Like, people don't see the benefit of the 2-bedroom, 1-bath, which we see a lot of here. We're in a good starter home. Yeah, I mean, this is well refurbished, but a lot of buyers, I think, look at the future and they want their forever home for their first home, or they want a forever home-esque like house, something that's like that for their first home, and they don't see that buying and just getting in the market with any home is actually kind of more beneficial if it fits them.
Right.
It's
a conversation that I have all the time with clients, that buying a home, I get it. It's an emotional process. It very much is. but if we can step away from the emotion and enter into a conversation about the wealth building possibilities of utilizing real estate, that's where I get really excited to work with my clients to help them realize what they can do from a financial standpoint for their future. When you talk about a home and the fact that once you're into a home, in our market anyway, it's been fairly steady appreciation rates, not outstanding, but that home is going to increase in value. And while it's increasing in value, you're going to be making monthly payments. You're going to be paying that loan down, and that difference between your loan amount and that increase in value, that's the equity that you're gaining. That is cash that you can realize into your pocket at the point in time you sell that home. And you know, in a lot of instances, even a starter home, with the VA, you have the benefit of being able to buy that home with no money down. That's a great position to be in. At the same time, if you own that home for, say, 4 to 5 years, chances are you may be sitting on, $40,000 to $50,000 in equity at the point in time you sell that home. And that's the conversation that I have with my clients: is what else are you going to do in the next 4 to 5 years to put $8,000 to $10,000 a year into your pocket? That's what real estate can do. And if individuals can realize the stepping stone, let's start small and grow into it. You can grow into, sell that home in 4 to 5 years and take that additional equity and step up into something a little bit better. Do it again in 4 to 5 years. In 15 years, you can really step up into a sizable down payment that you can get into that forever type home if that's something that you choose to do.
Nice.
Yeah.
Yeah, I want to get a little deeper into equity here in a second, but sticking on that VA home loan kind of just general FAQ type question, right? How do I know if I'm eligible for the VA loan?
So any current modern day active duty service member, at the point in time you are beyond basic training and at a duty station for at least 90 days, you are eligible for your VA home loan benefit at that point. That's the active duty side. The reserve unit side is a little bit different. It's a longer period. It's more like 7 years for the reserve unit side. And then if you are a veteran, depending on your circumstance, you got to go back in years. They had different guidelines. But the biggest thing is either getting with a lender like myself who has access to the VA portal. It's very easy. In a matter of minutes, I can pull your certificate of eligibility. Or if you have access to your VA online benefits, is just jump in there and pull your own certificate of eligibility, and it'll tell you right there if you are eligible or not.
And for veterans or active duty soldiers that are considering getting out, does that VA home loan benefit, does that ever go away?
It does not. Once you've served your 90 days, that eligibility, that's okay. You always have to throw out the disclaimer.
Yeah.
There can be circumstance in which the military or chain of command has deemed you not eligible, so we do have to throw that caveat in there. But for the most part, no. Once you've met your requirements, it's a lifetime benefit for you to utilize.
Okay, and still with that, right? So I use that VA home loan. I bought a house. Maybe I want to turn it to a rental, right? Well, first, actually, why don't we talk about that? How have you seen veterans or active duty soldiers as they've gone, station to station? How have you seen them build a portfolio rather than selling and getting that equity cash out? How have you seen them utilize their VA home loan to build a real estate portfolio?
That is it's an excellent question, and it's one that, quite frankly, the service members have an edge over civilians. If you want to build a real estate portfolio, if that's something that you truly want to do, the program is perfectly outfitted to do so on multiple levels. For one, when you look at the investment side, there's no other class of individual out there that can ultimately build a real estate portfolio by putting truly no money down. Any other class of individual is going to have to find money to fund the circumstances in some way in order to get the process started. And that's the greatest benefit of to me, the VA loan program is once you buy a home, there are some restrictions. There's a lot to kind of go into it. First of all, when you're using your VA benefit, it has to be for the purposes, there's no exceptions to this, it has to be for the purposes of a new primary residence for you to live in. Okay, so as long as you're willing to adjust that, make this your new permanent address, if you stay in that home, the minimum requirement typically is 12 months. So as long as you use that primary residence for 12 months, after 12 months, no one's really going to say anything. If you want to go buy your next property, with the caveat that you are going to change addresses, you're going to move into that new property and consider that to be your new primary residence and continue to move forward. There's nothing that you have to do with the mortgage on the first property. You leave that in place. There are even guidelines for refinance on those properties, which is a whole other discussion of the VA's refinance program. It's an interest rate refinance reduction loan. Got to leave it to the Army to have an acronym. They call it an EARL. There's rules written in there that as long as that address that you are refinancing was formerly a primary residence, and you can document that, you're still eligible for that VA loan refinance program, years down the road. And so individuals who are willing to live in a property at least for a year, potentially, getting into that property at no money down if you choose to, you can go move into a second property after a year later and continue to build that portfolio. Now, once we're into 1 to 2 to 3 properties, we get into a deeper discussion about entitlement, which is a back-end qualifying factor for the VA loan program. We can have a whole discussion about entitlement. But for individuals that want to do this, really the greatest house hack, mortgage hack product that's out there is the fact that service members, veterans, active duty, if you want to get into the real estate gig, as long as you play by what we call primary residence rules, which is a property that's it can have up to 4 units. So it can be a single unit home, it can be a duplex or 2-unit home. In some areas there you will find a 4-plex. As long as you as the service member are going to occupy one of those units, you can purchase that property. You're going to have, let's say it's a 4-plex, you're going to live in one and the other 3 units are rented. That rental income that's being received in those other 4 units goes towards your qualifying income. And you talk about the ability to build a real estate portfolio really quickly. An individual who was in a market that had 4-plexes, as long as they were willing to move and reside into one of those units, within 3 years, you could have a dozen rental units under your name in a very short amount of time, and chances are very little to no cash out of pocket in doing so.
So you can use it for multifamily, right? It doesn't just have to be single family. Is 4-plex the max that you can use it for?
Yeah, anytime you go above a 4-plex, you move into commercial lending guidelines, and you'll move outside of VA capability at that point.
Okay, all right, that makes sense. All right, a little bit. So on no down payment, right? So the VA loan, no down payment is, but then people kind of go, all right, it's no money down. What's the difference between that? No down payment, no money down with?
Well, the biggest thing, biggest complication that I run into is individuals kind of misunderstanding that when buying a home and using your VA benefit, there's sometimes a misconception that there's no cash requirement for them as a home buyer at all. That's not the case. Your VA benefit does allow you to buy a home without having any down payment of any kind. When I talk to individuals, I talk about having what we call, when you're buying a home, there are really 3 buckets of money for every real estate purchase you're ever going to go through. There's 3 buckets of money that you have to consider. The first and largest bucket of money typically is there a down payment requirement of any kind? With the VA benefit, you have the option to put no money down. So the answer to that bucket is, can we get into this home with no cash out of pocket? The answer is yes. Your next bucket is your loan fees, your transactional cost of the loan itself. There may be some lender fees, some origination costs. You're going to have to pay for an appraisal. There's going to be title work done on the home. There's going to be inspections typically that you will complete on the home. Those transactional costs are bucket number 2. Bucket number 3 is what we call your prepaids and your escrows. Anytime you're buying a home, by federal guidelines, if you're financing that property, you do have to have homeowner's insurance on that property. You'll typically pay that homeowner's insurance premium the first full year. You'll pay that up front, and then you'll begin to establish your escrows, which are savings accounts in order to pay your property taxes when they come due, and to have enough money available to pay next year's insurance premium when it comes due as well. And so those other 2 buckets of money are cash requirements that you're going to be faced even in a VA home loan. And so oftentimes the confusion comes in is that an individual may have bought multiple homes and they never really had any cash out of pocket. Well, chances are what occurred in that instance is that they had a good realtor who negotiated to have all of their costs paid by the seller side of the transaction. It's optional, but it is something that has to be negotiated. It is not guaranteed. You talk specifics here in our market, call it this north central Kansas area. That bucket 2 and bucket 3 of costs of a real estate transaction typically going to run somewhere between $7,000 and $8,000 in a lot of cases. That'll catch the majority of homes here in the market. Those costs are either going to be paid out of pocket by the service member or negotiated to be paid in part or completely by the seller side of the transaction. So not to confuse the two, you do have the option of no down payment, but there are still costs associated with buying a home.
Yeah, that's what I was going to bring up as well. And speaking from the realtor side, it's very beneficial to have a realtor who is knowledgeable of the whole process, knowledgeable about, hey, you can actually take your inspection costs, you can ask and request those inspection costs to be rolled into the closing costs, and you can, with that, your negotiated pool of money, if there's any concessions that you negotiate with that seller to cover those closing costs, you can really, that's how you get in the no money down zone. But what the benefit as a realtor working with someone like yourself is too, and you've done this in the past with me, is walking through the different levels of, hey, you know, what the breaking down different offers as well and helping in that negotiation process. And that's really, I say that just as a testament to any buyer or seller really, but especially buyers, it's really smart to have a full team that they trust, you know, like people that they can, that are going to advocate for them and that know the process. So real quick on just brass tacks of things, credit score requirements. What are the credit score requirements of a VA loan?
This is another piece to the VA loan that causes a lot of confusion, and that a lot of service members don't understand or don't realize. The VA itself do not impose any of the credit standards. There's no federal guidelines set forth by the VA for credit approval criteria, and credit score, of course, being one of those. Each individual lender, that's the biggest thing to keep in mind. Each individual lender sets that credit qualifying criteria. And this is where we get a lot of confusion. The military is a very cohesive group. Guys are moving constantly, and they're talking to their buddy who bought a house before, and that guy may be saying that his lender told him that the minimum credit score he had to have was a 620. And then you step in front of another lender, and maybe that lender is saying that the minimum credit score is a 640, and this causes confusion between service members. And what the biggest point to help people understand is that what they're dealing with is each individual lender is setting that credit score. For us personally, I mean, we can go pretty easily down to a 580 in a credit score. And we even have a couple of investors. That's the benefit of working with a broker as opposed to, say, a community bank or a retail lender. We as a broker, we have a multitude of different investors that we can go to, and we have relationships with. And we have a couple of investors that, let's say maybe you're in the 550 or 540 range. They're going to look at other factors. Maybe you're sitting on quite a bit of extra cash. You've got cash and savings, you've got retirement accounts, things of that nature. They may still potentially approve that loan at an even lower credit score than what is standard. And so it's a kind of a challenging question. The biggest thing to keep in mind is that not all lenders are created equal, and just because you get turned down by one doesn't mean you're going to be turned down by all. So if somebody says no, go find the next guy and find out what his qualifying criteria are.
And once they're qualified, once they're approved, does that mean they're going to receive funding for that house, towards the end, getting to closing? Is it a guarantee that the deal, they will receive funding for that house?
That is a great question, and in all honesty, the answer is no. In that originators are not the final decision makers on the loan. The better the originator, the better that they understand the guidelines, the more due diligence that they do on the front end with that pre-approval process, that all increases the likelihood that loan will definitely close. But the biggest thing to keep in mind is it has to go through an underwriter before reaching final approval, and they may discover some things that we didn't in our due diligence on the front end. And the other thing to keep in mind too is it's not just the individual and your finances and the credit side of things. The whole other world that has to fall into place is what's known as the collateral side, which is the property itself. The property that you're buying has to meet certain qualifying criteria, and it will go through a VA certified appraisal inspection to answer some of those questions of does it meet that criteria. And so there's the collateral universe has to all align along with the credit universe, and if you can get those two to intersect in the middle, chances are you've got a final loan approval. And those are things that a good originator is going to try to not let buyers see all of of what we go through on the back end in order to get a loan together. We want to make that process as smooth and seamless as possible. Due diligence on the front end from a credit standpoint, working with a great realtor who has the eyes on the property and can answer those questions up front. That's the biggest thing is, again, you've made reference several times to having a good team. If we can put a good team out front and answer as many questions on the front end, all of that just greatly improves the chances of success on the back end.
I just ran it. What was I going to say there? Oh, yeah, exactly. So with and then with that, so what are, talking about the good team, everyone advocating for you, but on the buyer side, what are some to-dos, or maybe more importantly, what not to do when in that escrow period? What should they stay away from doing?
Gosh, we can get into a lot of things, but the biggest thing to keep in mind is try not to make any significant, massive changes to your financial position. That's the biggest thing. Keep your bills paid up. Don't fall behind on a credit card payment. Don't miss a car payment. Another big one that's out there is individuals that may have a spouse that has student loans. Make sure that if the spouse is on the loan, keeping up on their student loan payments, which can be an issue right now. Speaking from personal assistance, I've got 2 college-age students right now, and the student loan program is a mess. But to also give yourself time. Don't go out and buy a new vehicle. Don't go out and buy new furniture. Biggest thing, don't make large expenses. One of the the saddest stories that I can relate that we went through just last year. People have strong attachments to pets, and had an individual who was pre-qualified, and their pet, who they treat just as another family member, got sick, had to go in. I think the vet bill was like $7,000. They didn't think twice about it. They paid it and depleted all of the cash that they had for, they weren't able to negotiate all the seller concessions, and depleted all of that cash. Now, we were able to save the deal. We went back to the sellers. There was a renegotiation. They elevated the sale price and asked for more in seller concessions, and we kept that deal together. But the borrower didn't think twice about it. They had spent the cash, and then we were getting ready for, we sent them their final closing documents, and they're like, oh my gosh, we no longer have the cash available to close this transaction. And so that's the biggest thing, is open communication. Try not to change don't make any large expenditures, and keep your bills paid on time. Yeah.
And say someone did do that, they buy a surgery, a car, a couch, or something like that, and financing does fall through, are they going to lose that earnest money, or is that going to be returned to them, even though they kind of secondhand sort of cause a rift in that deal?
That's a great question, and it comes down to the individual real estate contract that they were signed, and what kind of leniencies or outs are involved in that contract. It also comes down to us as the lender. If there's just absolutely no way to salvage the deal, just in the case in point, what we had last year, we restructured things and got it to bring it back around. We're still able to close it, but if we can't find any other workaround, our last resort as a lender, because they can't fulfill the needs, we ultimately do issue a denial. And then it comes down to that real estate contract as to, if denial paperwork is issued, what's the ramifications? Each individual market is going to handle that a little differently.
Mm-hmm. So we've talked about, kind of hopping back, we've talked about single family, we've talked about multifamily, and then 2 other buckets that people might be curious about. Can you purchase a house that is a quote-unquote fixer-upper? So, and by that, let's say like a real fixer-upper, not like, they've got, mid-century wallpaper, et cetera, something that maybe they'd have to do some significant work, but they really want the property.
Yeah. There is a class of VA loan products that are referred to as just rehabilitation loans, and you can build the cost of renovation into the loan. that takes the complexity of the whole purchase, the whole acquisition, kind of to a different level. And because we have to bring in, at that point in time, we have to bring in a builder or a contractor in order to, we have to have bids and estimates on the front end to go with that transaction, because the appraiser has to have those remodel plans, the estimates, all of those costs have got to be part of their appraisal process. And what the appraiser will do is they will make an as completed value determination on that property. So they have to take your image, whatever documentation you can give them of the repairs and the updates, they have to take that into mind when they're determining the value of that property. And would this property appraise down the road once completed? Would it appraise, even though right now you might be looking at something that's, the walls are half torn apart, or maybe the plumbing is shot, and they've got to be able to make those determinations in advance, basically off of paper. You're bringing in a builder at that point, and there are timeline restrictions, and you've got to be able to fit the timeline restriction of those renovations being completed, typically within 180 days, so 6 months, from the date of closing. So that becomes the real challenge, is finding a builder who can move and work through their timeline and to completion in amongst the rest of the projects that they may have going on. But it's referred to as a VA renovation loan. A little more complex, but yeah, it's possible.
Yeah, and this may be a similar process, but as people may not know, and I'm sure you know of, is that the Junction City area, probably other areas as well, but Junction City has a great land bank program which allows people to buy land for about quarter-acre plots for $5,000 and receive a rebate of about $4,000 if they build within that first year. So referencing that, but also in general, the idea of new build. What can a VA loan be used to buy land and then build?
So great question. The land piece all comes down to the individual's timeline. If they're buying vacant land in order to build on immediately, like you've got to start, I'd have to go back and look at the guidelines, but it really is, construction needs to be started in like 6 months or so. So it's really kind of a simultaneous process all the way through. There is what is referred to as a VA one-time close construction loan, where you're buying the lot and obtaining financing. There's a single appraisal done on the front end, and you can construct that home using the VA new construction loan for those purposes. Now, if you're just wanting to buy land today and set on it for 4, 5, 6 years and then build on it later, the VA will not allow that. It's got to be in conjunction with a ongoing construction simultaneous project. Yeah.
Well, I think we've pretty much well covered it, but as we kind of wrap up here, is there what's something, and you might have already said it, but what's something about the VA loan that a lot of people have misconceptions about that maybe be benefit to clear up?
One of the misconceptions that we've kind of touched on, but not really, is that there is no limit to the number of VA loans that you can have simultaneously at any one time. We did touch on just briefly the back-end factor of entitlement, which is really, the entitlement is the amount of exposure that the VA is willing to have for any one service member. And by exposure, understand that the upside to the VA loan program for a lender is that it is a government-backed loan program. So for us as a lender, that mitigates our risk in the event that a buyer should default on a loan for any reason. We take less loss because the VA is going to cover part of that. That ties into entitlement. That entitlement is the amount of exposure that the VA is willing to have with any one service member, or coverage that they're going to have should those individuals default. And so that entitlement factor comes into play with your no money down scenario. There are no limits to the number of times you can use your VA benefit. There's no limit to the number of times, the number of VA loans that you can have simultaneously at any one time. The limit that you're going to experience is at some point in time, you're going to exhaust your available entitlement, and the VA will then begin requiring a down payment. So that's when the down payment piece changes, is that when you've exhausted entitlement, you may be forced to pay a down payment, but it's simply because the VA is at their limit for what they're really willing to risk for you as an individual. I've ran across these with a couple of my guys that are using the VA loan to build that real estate portfolio. And what we do at that point in time when they've exhausted entitlement is we simply look at maybe their oldest property that they've had for the greatest amount of time, that should, in theory, have the greatest amount of equity at that point, and we look at doing a refinance of that initial property and move it over into, say, a conventional loan product of some sort. That frees up the entitlement that was associated with that first one, and now that individual can go maybe look at that next property at a no money down situation. So it is fluid. It's just a matter of working with a loan originator that can help you navigate through those strategies.
How do they determine entitlement? Is that similar to a pre-approval or something, or is that? Yeah.
Entitlement is a set factor by the VA. Every individual county across the U.S. has a VA loan limit calculation to it, and within that loan limit calculation, the VA, their top end of a purchase within that county, whatever the loan limit is, your entitlement factor is 25% of that loan limit. And that's why, too, when individuals are looking at buying multiple properties, you really need to work with a lender that can calculate where you're at from the existing entitlement that you have utilized, in addition to the county that you're moving into, how much do you have available, and can you buy that home at no money down? It's a fairly extensive little Excel spreadsheet that we have that does all those calculations, but it does need to be taken into account as part of that pre-approval process.
So does someone's entitlement change as they maybe progress in the Army, they rank up, or they maybe move counties? Is their entitlement going to kind of shift as well, or is that a flat?
Pay grade and rank does not change your entitlement whatsoever. You did mention briefly the individual county in which you are living in. There are some high-cost counties across the U.S. That have a higher loan limit, which does make variation. Out here in rural Kansas, we're at the base level. You get into some of your larger metro areas. We have a lot of soldiers that work out of the Virginia and D.C. area. They are all in a high cost area up there. That's going to change that entitlement calculation. When you're in those high cost areas, you just have to be working with a lender that can help you with those calculations.
And now shifting gears a little for the civilian, right, that has no VA loan entitlement. Specifically here in Junction City, we have a loan program that is maybe not as versatile, but it's similar, right? So out here, if we're talking about just comparing a no money down loan option, is that your question? Yes. Yeah. Out here we have the what's known as the USDA Rural Development Loan, which is a no down payment required loan program. It's still a government backed, so it has some of those similar requirements to the VA loan from that perspective.
The challenge with the rural development loan, as the opposite end of the spectrum with the VA loan, it's probably the most restrictive loan program that we have, in that it does have a set credit score requirement, which is the highest of all the loan programs that we have. Minimum score is a 640. And the other thing that it has is the other credit qualifying criteria. The VA loan, oftentimes we can go well above 50% in what we call a debt to income ratio. The USDA has the most restrictive, that we are hard capped at a 41% debt ratio. The other thing that the USDA program has is it has income limits, household income limits. So it takes a factor. We've got to be able to determine and verify the total earning potential of an individual household, whether there may be individuals in a home that aren't on the loan, but do live in the house, that are above the age 18 and working age and earning a regular wage. We've got to take the total earning potential of that household, and it's got to fit inside of USDA's cap. That's even variable because it's dependent upon the number of individuals that live within that household as well. And so it is a great program that works. And the other restriction is it is geographic based, and there are you just have to, again, visit with your loan originator as to ask the question, hey, would this home qualify for a USDA home loan? It's a matter of plugging it into their system, and it'll tell you immediately if it's eligible or not. But the whole the city of Junction City, Ogden, everything from here west in the state of Kansas is all eligible for USDA.
No, sorry Manhattan, right?
Yeah, sorry Manhattan.
But all right, now a little bit kind of wrap up, maybe a little bit of market speculation, right? So we're in the days of Doge, we'll call it, and
here we go.
you know, what do you see with these government-backed loans? Do you see any shifts already, or shifts to come? Do you see any change at all that might come down?
Right now, what we're seeing, no. Not to get into the political side, but what we're seeing so far, we're not really expecting any drastic changes from loan program standpoint. Not to say that things won't change. I wish I had that crystal ball, but one of the things that will be interesting to watch, we mentioned earlier the Consumer Finance Protection Bureau, the CFPB. They just appointed a new president for the CFPB. His initial comments were nothing drastic on the horizon. And so that kind of calmed everybody down that, yeah, we should be good. But, you know, as you and I both know, politics change. And if the administration feels like they need to force a move, then we'll deal with it at that point in time. But right now, I think there's a strong desire to drive housing within the U.S. It's such a vital part of the U.S. economy, the U.S. strength, the confidence, just the mentality of consumers. If they can get into the housing that they want, that builds consumer confidence. And so I think there's a kind of an underlying push to try to help housing, and the last thing they want to do is destabilize things by making a bunch of changes right now.
Yeah, and there's definitely been a lot of talk on either this administration, prior administrations, addressing high cost of homes, addressing down payment price, income, supply of housing. So from your standpoint, we can still keep it not political, but if you could wave a magic wand, right? If you could make one big change and you would immediately enact in order to improve the housing market in general, whether it be, you know, pricing or getting in or both somehow, what would you do? I know I didn't provide that question.
That was completely off the cuff.
I know. I had to ask though, so you know we can cut it if it gets too bad. But you know, the thing to keep in mind is that there are programs out there to try to stimulate
housing. There's down payment grants and funds and things of that nature that are all an attempt to drive housing. My issue with many of those is there are back end negatives to the consumer, whether it's locking them into a home for a long period of time, or maybe it's an elevated interest rate in order to receive the grant funds. And then we could talk about the whole issue of where's that funding coming from, that we could get into a whole Doge discussion with those funds of where that's actually happening. The biggest thing that I think that could potentially happen, and there are some levers being pulled to try to get there. Keep in mind that the interest rate market is driven by the stock market, and it's driven by investor confidence, and specifically in the bond market. And that's the piece that's changed a lot over the last 10 to 15 years, is how global our economy and our stock market has become. To get into a situation where the world economies kind of start coming together and understanding that, whether it's U.S. citizens, other citizens are being affected by what's going on the investor side. At the point in time, some of that can calm down. Investor confidence is going to grow. The value of that bond market is going to increase, and then ultimately that will result in a decrease in interest rates. Can we get there? That's a great question. But at the point in time you can allow a free economy to drive the housing market, that's when we're going to be in our best position possible. So I know that's kind of skirted around your question.
A little bit, but it makes sense,
It makes
I don't want to
sense.
put you in hot water or anything. No.
The grant programs are just something that I really struggle with. I would rather spend 6 or 8 months working with a consumer with strategies to put together cash, improve their credit score, put them in a better financial position to be a homeowner, as opposed to just giving them something for nothing and not really improving their financial situation. Grant monies tend to allow individuals to go above their spending limit of where they should be at, as opposed to fixing the root issue, which may be some financial education and some financial prowess for that individual. Because again, I'm looking at this long term. The grant program is a great fix for right here, right now. But I want that individual as a lifetime customer, and chances are they're going to buy a home again, and I want to have them in the best position possible for their second and third transaction, as opposed to just their first.
So you would say maybe even if someone's not considering buying a home, right? Because how long does the pre-approval last for?
The pre-approval comes back to your question earlier of not changing your circumstance. Pre-approval letters that individuals will receive depends on the individual lender. I know ours personally say that it's good for 90 days. I've seen other letters that are good for 120 days. The biggest thing of it is once you have a fair amount of due diligence done on the front end, if you're not changing your financial position drastically, you haven't bought a car, you've stayed current on your payments, that it's just a matter of updating the paperwork to make sure that pre-approval stays good for a longer period of time.
Yeah, I asked that to kind of tee off so even if someone is not interested in buying within 4 or 5 or doesn't have the ability to, it's still, you're saying maybe it'd still be beneficial to reach out and talk to you, maybe get some financial wisdom from you, or maybe resources on counseling, etc.
I truly would visit with a lending professional. I'd love to visit with all of them, but find someone. And this is maybe a bit of an unpopular opinion. Financing and and the mortgage market has changed. I see a lot of consumers that are falling back on, well, what did mom and dad do? What did grandma and grandpa do? The financial structure of a mortgage has shifted. It's not the same as it was years ago. The cost of homes are different. Wages have not necessarily increased, so individuals are having to it's not that if you want to put 20% down, you can. But right now, most consumers, their cash position is not strong enough to put 20% down. So that involves other strategies to get into a home. Again, we talked about it earlier, to put yourself in an equity position in 4 to 5 years from now, to put an extra, $40,000, $50,000 of cash in the bank. Let's start working towards a strategy that can do that. You're going to be monthly. You're spending money every month on housing of some sort. Let's utilize a mortgage structure that can get you where you want to be, that can build wealth over time, and that involves maybe some strategies with lower down payments than what we're used to. So I highly encourage individuals to visit with a mortgage, more of a mortgage advisor as opposed to just a mortgage originator, because not all of them are going to take the time to maybe delve into your credit report and look at what changes can be made from that perspective. Maybe there are some suggestions that we can make to boost that score temporarily or in a short period of time and put you in a better position, which will ultimately save you thousands of dollars of interest. So,
all right. Well, thank you for spending time with me today, and I encourage any buyer, seller, or even realtor to follow you at Todd Nutsch Home Loans. Yeah. And you put out great wisdom. I know that I've utilized one of your videos, with the wisdom I learned from one of your videos. I utilize it with a client, and so yeah. Thank you for your time.
I appreciate it.